the most important asset for Tesla is Musk.
Many of these investors see the success of Tesla inextricably linked to Elon Musk.
You hire a CEO to advance your company and grow your company. And look at what happened with shares of Tesla. You are rewarded if he meets the metrics that are laid out.
Tesla CEO Elon Musk was just awarded the biggest CEO package ever with a potential value of $1 trillion. Musk is already worth more than $650 billion following the release of that 2018 pay package after a lengthy legal battle in a Delaware court. This new pay package could make him the world's first trillionaire.
And what we're about to embark upon is not merely a new chapter of the future of Tesla, but a whole new book.
Over the past 50 years, pay for CEOs has exploded. Since 1978, top CEO compensation has climbed over 1,000%. So, why has CEO pay seen such a massive uptick in the past 20 years, and how much of it is skill and how much is luck? CEO pay packages aren't just one giant paycheck. Pay packages are usually made up of 4 categories. So you've got salaries, you've got long-term incentives, you've got short-term incentives, and perks. Now, long and short-term incentives are largely made up of stock awards. Stock awards accounted for more than 70% of CEO pay packages in 2024, with the median value climbing almost 15% to $10.3 million that same year.
So stock type compensation is actually the largest form of compensation that CEOs receive, either in the form of some kind of stock transfer or stock options.
Elon Musk's pay package doesn't include a salary at all. That $1 trillion in compensation is actually made up entirely of stock awards. Now, his awards are contingent on Tesla hitting specific targets. Those include delivering 20 million vehicles, selling 1 million robots, and earning Tesla over $400 billion in the next decade. Each milestone awards Musk an additional 1% of stock, meaning he could still earn billions in stock even if he doesn't meet all those targets.
Milestone achievements built into CEO pay packages could be the norm in the near future.
Former Coca-Cola CEO Roberto Goizueta became the first non-founder billionaire CEO in history, not because of his salary, but because of Coca-Cola's stock. In his 16-year tenure, Goizueta increased Coca-Cola's market value 3,500% from $4 billion to $145 billion.
After Dodd-Frank and a number of the other regulations during that period, there was a greater emphasis on aligning corporate performance to executive pay. And as a result of that, companies began to pay their executive more so in stock award and equity.
Stock awards also tie CEO pay to stock performance, giving them a vested interest in the stock gains. Now, this is especially true for founders of publicly traded companies. Billionaire founders that are also CEOs, like Meta's Mark Zuckerberg, NVIDIA's Jensen Huang, make money through the equity stake that they hold in their company. That ties their wealth to the success of the company and gives them more say when it comes to decisions made by the corporate board of directors.
Mark Zuckerberg, Jeff Bezos, historically, obviously founder CEOs, historically they took little to no compensation, but because they have such large equity stakes in their company, they've kind of just been content with where they've gone.
Since the 1990s, pay packages have largely shifted away from stock options, which only realize gains if the price increases, to stock awards, which actually just move with the market.
And I think that there's a leaning on longer-term incentives for the stock to grow over years and not over days or months, so that those top high-end CEOs have an incentive to actually make the company better over time, as opposed to that kind of trading that might happen in a short-term basis.
There is also another factor to consider when analyzing CEO pay growth, and that's who is actually making these decisions. Now, CEO pay packages are often assembled by a board of directors in conjunction with a consulting firm. Publicly traded companies will then have their shareholders vote in an advisory capacity on the package. This is called the say on pay vote. Still, the company's board has final say when it comes to compensation.
but oftentimes there are other CEOs from other companies on each other's boards, and so they're dictating the pay of their peers, and they don't have the same incentives to rein in that pay as others might, as maybe the stockholders would.
Take Apple, for example. Apple CEO Tim Cook's 2024 compensation package hit a value of $74 million, despite retaining a $3 million base salary since 2016. That pay package included $58 million in stock awards, $12 million in cash incentives, and $1.5 million in additional benefits. So if you take a look at Apple's board of directors, you'll see it's almost entirely made up of former or current executives from other companies.
What they often do is compare the CEO at this company and his pay with his peers at other competing companies, and then recommend that they give their CEO a package that's a little above average for the peer group. And so that way it keeps ratcheting up.
But when it comes to these massive pay packages, is there an actual tangible benefit for the company? Tim Cook consistently ranks as one of the top paid CEOs in the world, taking over the company from founder Steve Jobs in 2011. Now, during his tenure, Cook saw Apple's valuation climb from $364 billion to a multi-trillion-dollar company in under a decade. Under Cook's leadership, Apple's share price has climbed more than 23 times its original price. Other high-end CEOs who oversaw massive growth in their companies include Palo Alto's Nikesh Arora, former Chipotle CEO Brian Niccol, and Walmart CEO Doug McMillon. On the other side of the argument, some studies found that CEO productivity does not actually align with the increase in compensation. A 2023 study found when comparing CEO pay to that of the top 0.1% of U.S. earners, even the country's top wage earners trailed CEOs in comparison. Between 1978 and 2022, top wage earners saw their annual earnings climb 377%. CEOs saw their wages climb 1,370% during the same period. The study found this disparity signaled that CEOs are often claiming income that greatly exceeded their actual contribution in producing it, concluding, quote, if CEOs were paid less, there would be no loss of productivity or output in the economy.
It's this notion that the guy in the corner office is somehow almost single-handedly responsible for company value, and everyone else is just little, minions who don't contribute much of anything. Everybody can see that is not true.
When it comes to pay for performance, there's also very little correlation between higher pay and better stock performance. A 2021 study looked at top U.S. executive pay between 2006 and 2020. The study found weak correlation between higher CEO pay and company performance, and in some cases found lower paid CEOs resulted in better returns for the company. Now, in contrast to CEOs, worker pay has actually stagnated since the 1970s, while their productivity has increased. Between 1979 and 2025, worker productivity grew 87%, while hourly pay saw an increase of only 33%.
Become more productive, more education, more technology, a number of different reasons that we become more productive as workers over the last 50 years. But the returns to those productivity gains have typically not gone to workers in, let's say, the bottom 90% of the wage distribution.
The average worker in the U.S. tends to see a small pay bump every year, whether that's through raises or career changes. In 2024, the average S&P 500 employee earned about $85,000, a 1.7% increase from the prior year.
There are many different factors that might go into how much anyone is paid. If they're paid on an hourly basis or they have an annual salary, how many hours they work, their exact credentials and how much education they have, how much experience they have.
Comparatively, median compensation for CEOs was $17.1 million, up 9.7%. Now that means S&P 500 CEOs are making, on average, 192 times more than the average employee. That's up 3.2% from the prior year.
That's really a bit on par of what we see year over year. We usually see about, on average, about a 10% bump.
But it wasn't always like this. Back in 1965, CEOs were paid 21 times as much as the average worker. It is this widening pay gap in executive compensation that has been a sore spot for labor groups in the U.S. In the summer of 2023, the United Auto Workers Union went on strike, with its founder Shawn arguing CEO pay was a core issue for the group. The average CEO pay globally is closer to $4.3 million. That's because fewer CEOs overseas get stock-based pay. One of the solutions for the widening divide between CEO pay and employees might actually lie with CEO compensation itself. Employee-based stock plans can look different depending on the company and what is offered.
ESOP is an employee stock ownership plan, and it's a federally regulated retirement plan that's designed to own shares on behalf of workers at the companies that sponsor them. So it works a lot like a 401k plan as a way for people to accumulate assets, but it also works a little bit like a mergers and acquisitions transaction because it's a way for a trust to buy shares from the current owner on behalf of employees.
Grocery store chain Publix is the largest employee-owned company in the country. Employees are given company stock through an ESOP.
The employees tend to end up a lot better off in terms of their financial security. The average employee owner, when they enter retirement, has about twice the retirement assets as a non-employee owner. Employee-owned businesses are more productive, they're more able to recruit people, people quit at lower rates, they're more competitive.
Other well-known ESOP companies include Bob's Red Mill, Winco Food, and Shields.
One company that I like as an example that people may not have heard of is called Springfield Remanufacturing Corporation. And they take big diesel engines from trucks and remanufacture them so they can go back out on the road. They were spun off from International Harvester back in 1983. Instead of going bankrupt, the employees bought it. They've gone from 116 employees to 2,000, and their stock has increased over that same time from 10 cents per share to over $1,200 per share.
But when it comes to CEOs, is it possible or even sustainable to continue to see their pay grow more than 10% every year?
There isn't any, sort of cap in sight in the foreseeable future. The one instance where I can see that happening is there's certain regulation or rules that come into play that cap CEO pay. So unless a company is required to put that sort of cap on their pay packages, then I don't see, any kind of end to this anytime soon.
If history is any guide, we're likely to see more billionaire and trillionaire CEOs in the future.